Welcome to the Motor Carriers Insurance Education Foundation's in-depth view of coverage addressing the unique exposures of a motor carrier webinars. This session is on the general liability coverage consideration for interstate for-hire motor carriers. These webinar is not filed for state CE and is a learning opportunity only. If you have any questions concerning CE or other things that are brought up in this webinar, please text them to or email them to trs@mcief.org and we will respond. All motor carriers need a general liability policy. In fact, all insureds need a general liability policy. Auto liability policies do not address all the liability exposures. So the first thing we need to think about is, are you offering it and how to offer it and providing the coverage? So unlike most businesses, truckers tend not to buy GL until somebody makes them. And I break this down into size. Don't get hung up on exact number, but a smaller motor carrier, 1 to 5 units they own. Usually there's no office. They work out of their home or the farm. So they don't see a GL policy needed. They don't have the exposure they need in that. And they don't often purchase GL, even though in my opinion, it's the best buy in the marketplace. Until somebody makes them, and the person who makes them is their shippers, their brokers, their customers, whoever they get the loads from. Because invariably during a period of time, it would be very typical for a small owner-operator, meaning not someone leased them to a large fleet, but someone who owns their own truck and has their own authority and hauls under their own ID, under their own registration, will run into a customer who requires general liability coverage before they'll provide them the load. A lot of shippers don't require that. It becomes a function of the insurer, the iron motor carrier going on to the insurer's yard or not. But when that happens, then they're going to call you as an agent and say, or the provider and say, that I need this certificate so I can pick up this load. And since they do not have a GL in place, then you're going to have a difficulty getting it done in time for them to haul that load. And in fact, the loss of income on that one load will pay for the GL premium for the whole year. Because again, the premium base is somewhere around $500, no matter how many units you have, up until there's a premise or yard, a garage, or things like that. So I think you need to talk to all your as agents, to your retail, to your insureds, when you're writing the auto liability policy about the need for GL, which I'll go through here in a few minutes, and why they need to go ahead as a precaution and buy it as a part of the package or a part of the insurance program you're offering. Not only the first time you write it, but also offer it at all renewals, because in case they did not have someone who makes them do it. Once someone gets over 5 power units, they now usually have a location they're working out of, and is the owner of that location, or in some cases they lease that facility from a storage place. And a lot of times those lessors of that property where they're having their location requires proof of coverage as a part of the lease requirement. And at that level, typically they will have their customer required GL. So to address the customer's requirements and the location exposures, meaning public coming on to these leased or owned premises, and that they will buy the GL policy. So I've been asked often, give me some examples so I can talk to my insured about why they need a GL. The first one we just mentioned, they have customers or other people on their insured premises for business purposes, and they don't have a premise as far as these dedicated business premises. They work out of their house, they do things like that. Well, unless their homeowner's policy, if that's all they have, is not going to address that salesperson, that Snap-on Tools person, their customer delivering a check or whatever else that's going to be at that premise in case they get injured on that premises, that's not going to be covered under homeowners policies without a separate endorsement. And that endorsement, the homeowners policy, will in most cases go a long ways to pay for the GL policy standalone. They furnish alcohol at a holiday party or after a safety meeting, hopefully not after a safety meeting. The employee drives under the influence and is caused by and causes bodily injury, property damage. Again, that's host liquor. This happens sometimes when they have the meeting, even on the insured's premises. It's for business purposes. And when I say employee here, the driver could be an owner operator. In that case, I'm using the federal definition of an employee in this case. Insured driver rents a hotel room to do the 10-hour rest after to meet the compliance with hours of service requirement, or after they restart after 34 hours. They smoke. Unfortunately, too many drivers smoke. There, as a work population, more drivers smoke as a percentage of that work than any other industry around here. They smoke, so they leave the battery charger and they cause a fire. That's the fire legal coverage for that room. Again, that's another GL exposure, and since they're there on business purposes, meaning to revalidate or to be able to drive the next day or the next week, they will that will be where the motor carrier will be brought into it, and that will be a GL exposure. The motor carrier performs repair on vehicles not owned by or leased to the motor carrier. And a lot of times they say they don't do this in this area, but I'm not talking about their own. But if they do work on an owner-operator's vehicle, and the owner-operator leaves the motor carrier, cancels their lease, no longer works for that motor carrier, and then that work fails, then that is now a GL exposure under the owner-operator. Under the motor carrier who used to lease that owner operator. So the repairs and this defective work here, they would extra parts, they would need that. No motor carrier, no insured needs a garage liability policy for the premise locations or for products and fleet operations, the work that they have done on those vehicles, whether they are owned or not. What they do need is an auto liability policy to cover the movement of those vehicles if they test drive it, or if they, or obviously if they're owned or leased to them, that would fall under their auto liability. They use self-defense to protect persons or property, causing bodily injury to others. Could be the guard dogs in the vehicles, no matter what any of the size are, or a lot of truckers are carrying guns, and they use those things to ward off someone breaking into the truck. And those persons breaking the truck could just, a lot of trucks are all red, and they were breaking into it because the driver didn't understand it's their truck. They parked it there. I mean, how many times have you all walked up to a car in a shopping mall and it was not your car? It just looked like your car. And they even use the billy club that they carry around, again, quote unquote, to test the air pressure in the tires, see how far they bounce. Again, that will be a situation where the person that they injured to protect that person or property then would create a claim against your insured for these actions, and that's a GL. Or failure to disclose drug problems for previous employers. Now we have the drug clearinghouse, which is going to be harder to do that, but that's one of the things they fail to do. They tend to hide that failed drug test. Again, today it's going to be a little harder to do it with the drug clearinghouse in place, because not only the motor carrier would have to report this, but also the drug facility itself. But then that information is using when that past employer calls up to verify that information, then they would not report that properly, and now the crash happens, and the person who's using the ex-employee, the previous employee, gets the question, why did you hire this person who had a drug problem? And it was because that was not divulged by your insured. Then that's a GL when they're brought into it, was saying, well, if you told me about it, I wouldn't have hired them, therefore they wouldn't have caused a crash. That's a consideration you have to think about. Loading and unloading, this is the big one. Used by a device not attached to the truck or trailer. Forklift, front end loader, cranes, motorized pallet jack, those kind of things. If your insured is involved at all in loading and unloading, meaning they do other than a drop and hook, they're hauling refrigeration goods, they're hauling dry van goods, they oversee the loading and unloading for those items, they are a tanker, they are hauling bulk products, they're hauling a flatbed that has to be unloaded by a forklift, they need a GL policy to cover the gray area between auto and GL. If you haven't looked at our session that we have of loading and unloading, but we go in depth on that, then I suggest you go back and look at that. If they deliver the product, including liquor, again, doing the loading and unloading at a location or into a reciprocal that isn't supposed to be it, and those products are used. The items that they unload falls over. The product puts gas in a diesel, and now that gas is put into a diesel engine that then gets burned up. That are the cause of this wrong fluids in it or gets damaged. Again, after it's delivered, then it is a GL product exposure, not an auto exposure. And then contractual liability. We're talking about people now with probably more than 5 power units, but if they sign leases to get on premises, they do a key stop. This allows them to make multi-stops for LTL truckers. They're involved in intermodal. They access the premise to load and to unload, anything like that. They're going to sign those contracts with the shipper or the broker. And in those contracts, they will require some hold harmless agreements, and those hold harmless agreements are addressed not only auto liability, but also on general liability. These are just the point. The biggest point here is the loading and unloading and the premise exposure, and we'll deal in more detail here, but these are some of the items that GL addresses that auto does not. The two, though, that's also beyond that is the insured uses the cause of someone else's auto class when providing load. That's vicarious liability. Now, what this is a subtle way to say is if your insured has a brokerage operation in the same legal entity, and when they arrange for another motor carrier to haul the load, or they're an exempt hauler that can allow other motor carriers haul the exempt load, and that person they gave the load to causes a crash, causes an accident, then you're insured because they arranged that load to be brought into the case, and GL addresses that. This is an unknown exposure that most people do not realize, but because it's not excluded and the insured, the person who is hauling the load, that unit is not owned by, operated by, rented to, or loaned to our insured, that it would have to respond. That's a major exposure that most people don't think about. And the last one here is, again, that certificate of insurance part of it to meet the insurance request to deal the load. So the previous slides talk about the obvious. These two talk about the unique part that they have involved here. If they that might be for some motor carriers who have that brokerage let someone else haul the load exposure, and or have customers who need a GL coverage reflected on the certificate of insurance before they can pick up the load. Here is the insurance agreement in the GL. Bodily injury and property damage liability insurance agreement. We pay all sums that the insurer becomes legally obligated to pay as damage because of bodily injury or property damage to which this insurance applies. This is broad wording. When we look at any other policies we have, they have, including auto liability, they have a caveat afterward that limits what the exposure's to. And so they only react to those, unlike the general liability policy, which has no limitation. Again, auto liability says arising out of the covered auto. So it has to be a covered auto for it triggers. Rising out of a covered event for employee practice liability, for D&O coverage, for those kind of things. Rising out of a professional act, that's your architects, engineers, doctors, professional liability. All those have a caveat here. The general liability policy does not. It's a catch-all form. It covers everything that's not excluded. Now, the things that I mentioned above, a lot of them are going to be excluded, so that doesn't mean they don't need those coverages later when we look at the exclusions. But going in, you got to realize that the general liability policy is the cornerstone that all other liability policies address what is not covered in the general liability policy. So that's another consideration here, having that overlying coverage for everything they do unless it's excluded. Just like auto liability, we got to worry about the name insured. On a name insured line, you only want to put the operating entity. That's the motor carrier. You don't want to have any other entity. That's the entity that has assets that can be subject to a judgment when there's a case or damage happen. You do not want to ever list an individual on the name insured line unless they're doing business as an individual. Tommy Ruke doing business as Tommy's Trucking, and therefore you'd want to, that's an individual. Thomas Trucking is not, does not limit or add to any kind of exposure that you might have. But you want to talk Tommy out of that. You'll talk me out of that. You want an LLC and a corporation. Once you're an LLC and a corporation, the only entity you want to name on the name insured line is the LLC and the corporation. If other people need protection, like they own the building personally, which we strongly suggest, or they own some equipment at the location, that which we also strongly suggest to be put in separate legal entities, you would want to add these owners of those legal entities as the owner of this equipment or these or the buildings own our GL policy, but you do that by endorsement, not putting their name on the name insured line. You also have to worry about classification. The GL addresses all exposure not excluded. This would also pick up unknown exposures. And for every risk, but maybe trucking, this is no problem because the insured comes back, knocks on the door, or excuse me, insurer comes at the end of the policy, knocks on the door and audits. A lot of GL policies aren't audited. So the concern we have here, smaller motor carriers, what the insurance carriers will do, and even some larger ones, they'll put an endorsement that limits exposure to the known exposures, or excuse me, limit coverages to the known exposure. They do this by adding the endorsement limitations of coverages to designated premises, projects, or operation. This is an ISO endorsement, CG 2144. And you put in there the premises as the motor carriers or the insured's address and operations. And I'll give you just a few words that you might want to put: operating as an interstate motor carrier, as a motor carrier within the trucker's classification, things like that wording that you might have. Now we're only going to cover their that operation. We're not going to cover anything else they might do. What could they do? Well, we already talked about a separate brokerage operation. We already talked about they could own the property in another legal entity, and they didn't tell us about that property. There's a lot of things sometimes these smaller motor carriers do with investment stuff, or even larger ones. So this endorsement is commonly used in the marketplace, and as an agent, don't be worried about it, because you got to tell your insured, all we're covering is your transportation. Do you do anything else? Now, I believe a garage to work on their own equipment falls under the trucker's classification, so that's a necessary part of their operation. And as an underwriter, you want to add this whenever possible, whenever you're not comfortable knowing all the exposures they're doing. So typically found with smaller motor carriers GL, unless totally information available is good, meaning financial statements, you go on their website and see everything that they're offering the public to haul, or the operations they're doing. These are things that you have here, and unless it's a large motor carrier, you're not going to be comfortable with knowing everything they do until you start looking at financial statements and find out where the source of incomes come to in that legal entity. So you got to explain to the insurer, do you have other operations than true trucking? And you need to ask them that at every renewal, because of this limitation of operations and coverages. And locations. That's an important endorsement to realize, but it's also a needed one to limit it to just our insurance operation as a trucker, because let's face it, a trucker does a lot of things that we don't know about, and most of the times we do not audit the GL policy, at least for these other locations or these other operations that they might do. We look at the general liability declaration, and I want to point here, because this also is what is unique by a motor carrier, and that's the limit of coverages. We already talked about the name insured to be the operating entity only, not an individual name. Unless they are an individual, then you want to put somebody else, then you want to convince them or try to talk them out of operating as an individual. But the focus here is limit insurance. We have three aggregate limits. We have the occurrence limit. That means for one occurrence, one situation, one claim, that's the limit that's going to apply. Then we have the general aggregate and the product and complete operation aggregate. Those are the two aggregates. That means all claims falling under that policy during the term year. So you have an occurrence limit, which most at one place, this is all we're going to respond, and the limits for this one occurrence. And then you have all the occurrence during the year fall under the aggregate, general aggregate or product complete operation aggregate. There are a number of businesses, one of which trucking, which there is really no product complete operation exposure. Travel agencies, insurance agency, trip tree trimming, some farming exposures. Classifications do not have one. So the proper way to find this policy is you have each occurrence limit, let's say typically $1 million, and then you have a general aggregate of $2 million. Typically you have twice the occurrence for the general aggregate, but product pre-operation aggregate, you don't have a limit in it for truckers classification. You should have NA, not applicable, or included above. Even though you exclude it, all you're excluding is the aggregate, not the operation itself. So for you who are not used to getting GL for truckers, or more important, where I run into this is where now you're trying to write an umbrella and excess policy GL. The umbrella and the excess carrier does not realize that the truckers classification do not have a product for the operation aggregate limit, and so even though they require 1 million/2/2, the second 2 is a product for the operation aggregate, they got to understand that in this classification you do not have that. So also the premium base for truckers, and this is the truckers classification code, GG 99793. If you look at it, they have a P plus a dagger sign or a symbol. P means payroll. And this is also a unique thing here, because when you look at a smaller motor carrier, if it's standard general liability payroll, and there's no exceptions in the classification, ISO classification manual, the payroll of drivers, quote, chauffeurs, payroll of terminal employees and repair are excluded, as well as clerical and sales. It does include terminal employees and repair people, but it does not, again, it does not exclude, I mean, the payroll for premium purposes does not count the payroll of clerical or sales. Think about your smaller motor carriers. Do they have anyone that's working for them until they have a location, until they have a warehouse, until they have a repair area, until they have parking for trucks around, who have anyone working with them that's not a driver, that's not clerical or sales? In most of those cases, the answer is no. So smaller motor carriers do not have anyone there that develop a premium under standard ISO general liability classification for premium purposes. Some specialty carriers, how they're handling this is they have a minimum premium involved in it, which again is somewhere between $450 and $700, depending on locations, depending on carriers here, and they end up also having a per unit charge that would be involved in it here. But then an audit, that way they just count the premium in it. So you need to be aware of how this, and particularly if your coverage is written on a non-admitted basis, because the non-admitted carriers do not have to adhere to all these reg and rules that are filed with the Department of Insurance in the various states. And so they might want premium for these people. So in the application process, you want to divulge all these payroll and see how the GL carrier reacts to those. And if they start charging premium for the driver's payroll or the clerical's payroll, the sales payroll, you need to ask them why and drill down on that before audit times if they get audited. And that's the concern that you would have, to make sure that you're paying what is contemplated in the rating manuals. Now, the dagger means, again, that there's no separate aggregate for product pre-operation, just the one aggregate for all losses paid under the form for the year. So current limitations, this would be a general aggregate, but product pre-operation aggregates you put included or NA, not applicable. Then you add an endorsement. This is what gets confusing. This is why insurance is confusing. You add a CG 2104 products and pre-operation hazard exclusion, but it does not exclude product pre-operation. It only excludes the hazardous, the aggregate. So this is unique to trucking, both how the payroll developed, that there's no one for smaller motor carriers to develop payroll, and that there is no separate product pre-operation aggregate involved in the payroll classification, the trucker's classification. Now let's look at it. It applies if not excluded. And let's look at a few of the general liability exposures. Most of them are similar to auto liability. So if you're not familiar with auto liability, they're here are the ones who are unique or covering things auto should cover. We can talk about the few here that are applicable to us. The first one you have exclusion A, which excludes bodily injury property damage expected or intended from the standpoint of the insured. This exclusion does not apply to bodily injury property injury resulting from the use of reasonable force to protect persons and property. As we talk about here, it doesn't extend to acts. That's where auto liability stops. But general liability could be for reasonable force, what they're doing. That baseball bat, the billy club, the dogs, the animals, the guns, and the truck. One of my favorite clients I've shared with you before is a beer company. At one point in time, we had a delivery truck down at Fort Myers Beach taking beer into 7-Eleven. When they were taking it into the 7-Eleven, somebody came in and somebody walked up and stole a couple cases of beer off the back of the delivery truck. The driver saw them doing it, and the driver got the beer back. They were a little bit forceful to do that, and the person they got it back from later sued because of the aggressiveness of getting it back. And our defense was, you're ugly then, you're still ugly, what's the cause? But this would not be covered under auto liability. This is general liability. My concern here is a lot of your insurers have guns and animals in the vehicle, dogs, even not guard dogs, and that is a concern, and that's an uncontrollable exposure in GL. So a lot of carriers add an endorsement to limit the animal bites or guns in it to take that coverage away. I just give you one carrier's policy numbers. This is not standard standard ISO. These are individual file endorsements that you have, which takes away coverage for ownership, harboring, keeping, or use of a dog exclusion. Sometimes they'll use animals in it, or ownership or use of a firearm exclusion. Those are what you'd have to look for. Again, it's pretty reasonable to have this, even though your insured has it. This is an additional exposure you've got that creates some GL exposures that underwriters are uncomfortable with. We talked about contractual, and the definition of contractual. The main one is that part of any other contract or agreement pertaining to your business, including identification of municipality connection with work performed for a municipality, under which you assume the tort liability of another for bodily injury property damage to a third-party organization. Tort liability means liability that would be imposed by law in the absence of a contract or agreement. That's broad form contractual. And so even though we exclude contractual, we do not exclude things that meet the definition of an insured contract. And this is an insured contract. What we're talking about is that when your insured goes onto someone's premises and signs an agreement, that they say, we'll hold you harmless, not only when you're held liable for our actions, meaning our insurance, but also will hold you harmless for your actions. That's broad form contractual. And that is covered under the general liability policies in case something happens on those premises, even though, for example, your insured driver trips and falls, your insured driver sues the owner of the premises, the shipper, and the shipper comes back and says, you agree to hold me harmless even for my negligence. It's not done often, but it is in the area where you have larger shippers. Sometimes those contracts are that broad in it. And so this is a concern you have, but you need to think about adding the additional insured endorsement does not cover that, because adding the additional insured endorsement only cover it when your customers or their people they're holding harmless are named in the suit for their vicarious liability. There is some state identification laws you need to think about, but this is the things in the contracts they sign. So motor carriers holds the customer, shipper or broker harmless when a claim happens and the customer is named in the suit because of the motor carrier's negligence. That's vicarious liability. That's what additional insureds cover. That's the more limited one in all the auto liability and general liability policy. The second one, though, the more pervasive one, is the motor carrier holds the customer's, shipper and broker harmless for damage done by the customer's negligence. This is what we talk about here. This is where the contractual wording, the insured contract wording, picks up this second one here. So here's the motor carrier's exposure. Addresses contracts between the motor carrier and the shipper. You have to deal with the state laws, and this is a big part of this, and this is what we're overlooking today, becomes more prevalent today. This has been enforced for contractors forever. But when your insured agrees to hold the customer harmless, even for the customer's negligence or anybody for negligence, if that contract venue and state law is in any other state. Now, any other state but Delaware, Mississippi, New Hampshire, and Vermont, it falls under anti-indemnification laws and cannot be enforced. And so what we got to look at the contract, you got to look at the first paragraph, who's the parties, to make sure they named our insured correctly. You got to look at another paragraph in it that talks about insurance requirements. Again, general liability, auto liability, work comp, and the limits, cargo in our case for carriage. You got to look at the indemnification part of the contract where your insured indemnifies their customer either because of their being held vicariously liable or to pick up their customers' negligence. And then you need to look at the last part of the contract, which says the venue, meaning if it's disputed, where state capital, where would it be fought at, where it would be interpreted under, and the state law that's going to be applied. Now, it doesn't have to be where the load's picked up. Even though this is not a trucking example, I'll give you one that I ran into with my son-in-law, who's a contractor working out of the small town on the far west part, northwest part of South Carolina, a little town called 6 Miles. They were doing work in North Carolina for a company that was owned by people out of Texas. And so the contract they signed was at 6 Mile in South Carolina. The work they were doing was in North Carolina, and that's all the work. But the contract said if this contract ever had to be interpreted, if ever had to be looked at to enforce the provision of this contract, it would be done in Dallas, Texas, under Texas law. Even though the work or the insured we are dealing with is not in Texas. And so that's what you got to look at. And if there's another state other than these four, you got to look at, if the other state other than these four, you don't have to worry about it. But if it's one of these fours, you need to look at and see if that contract is broad form or more limited for vicarious liability only. We exclude work comp. That's because we don't pay work comp or not. And then we exclude employee liability. This is the concern here in two things that we're going to talk about. It excludes bodily injury to an employee for an injury arising out and in the course of the employment by the insured or performing duties related to the conduct of that business. And here's the problem here. Most of your insurers will have work comp when required by law. Well, I say that maybe tongue in cheek because they'll try to get out of it by even misclassifying who's an employee. And that's a whole different subject for a whole different day that you have to be aware of. If don't use a true owner operator, that means someone who owns their own truck. If anybody's driving the motor carrier's truck that's owned by the motor carrier, they'll end up being an employee. I don't care if they're 1099 or not under the current interpretation of those relationships. So let's say you're in a state like Florida who does not require work comp until you have more than 3 employees. That varies and you have to check with the state, but the number of states, about a half a dozen states or more, have a numerical threshold before work comp is required. If work comp is not required, even though your insured has employees, they typically will not buy it. But if that employee then gets injured by the negligence of your insured, they trip and fall on your insured premises, they get hurt on the yard because they fall off a dock, something like that, that employee now can sue. If you had work comp, then that suit would be a stop because work comp that suit would be a stop because work comp is a sole remedy. But if you do not have comp, they can sue. And when they sue, you have no coverage for your insured because they're an employee and the employee exclusion applies. Even if the motor carrier requires or has his employee buy something called an OCAC policy. An accidental accident policy is an individual health product bought by the employee. A lot of motor carriers require these owner operators to have that. But what that does, they'll pay the injuries, they'll pay the loss of wages, they'll even pay death, but it does not extend toward immunity like work comp. So in this case, that owner operator can collect the OCAC and then still go find a lawyer and sue. And again, if they're an employee, that general liability and also auto liability, but general liability would not respond. However, you have some insureds who are independent contractors. They drive their own truck. They're 1099, no question. They're independent contractors. They're not an employee. Now, those people are on your insured premises and get hurt. And so in those cases on insured premises, they're no longer an employee. Therefore, the policy would have to respond. This is the real big exposure in the premise locations. So if the injured individual was an employee and the injury caused by the negligence of the motor carrier, our insured, the general liability would not cover that. And any product they buy themselves, like OCAT policies, would not preclude them from suing for those injuries, again, based on the negligence of our insured. So that's a big exposure in those areas that is uninsured. However, if that person got injured is an owner-operator, they're not an employee. They drive their own truck. They're 1099. No question that they're not an employee. Now, they get injuries on the premises because of the insured's negligence. Again, trip and fall on the ice, potholes, fall off the dock, anything like get run over by a forklift, get run over by a truck on those premises. That's the negligence of the motor carrier. Now the owner-operator can sue, and that's not excluded here. In fact, that is covered under general liability. To me, that is the biggest exposure that you might have that could cause claims other than the loading and unloading, which we'll talk about here in a few minutes. Now, the problem you have here is sometimes the insured feels comfortable by having that owner-operator have their even own work comp or have their OCAT policy we talked about before, individual policies. But in this situation, you got to realize that they can collect under that OCAT and collect under the work comp and then still sue the employee, because that work comp carrier only sends tort immunity to the insured, and the insured in this case is the owner-operator, not our insured. And so when these things happen on the owner-operators policies, you want to make sure that you get waiver subrogations on the OCAT policies or the general liability or the work comp policies, because even though that owner-operator might not sue, once the OCAT policy pays because of the injury that's caused by the negligence of the motor carrier, our insured, or when that work comp policy pays again on behalf of the employer who's the owner-operator, for the injuries to those owner-operators, truly independent contract owner-operators, that work comp carrier can then seek reimbursement from our insured, who is the negligent party, who's not their employee, employer. That's the big exposure you have to deal with and we have to be aware of. So if the insured uses only employees to accomplish their business and their work comp coverage is in place, then exclusion D protects the insured who's the employer or the motor carrier. But if no work comp, employee could sue. No protection under general liability. But if not an employee, they could sue. That would be covered in general liability. And the problem when owner-operator motor carriers use independent contractors, independent contractor owner-operator gets hurt on the premises by negligence of the insured, the exclusion doesn't apply. So that is the thing that you want to be careful about underwriting. Later we'll talk about what the activities there. Later we'll talk about what Google Earth will show us there. If it's just a payroll office, that's no big deal. But if the owner-operator comes regularly there to pick up loads or to have their vehicle maintained or even inspected, you have to worry about what that owner-operator is doing on those premises and can they get hurt from the negligence of the insured, and the GL policy would respond. And the individual policies, OCAT, health product, they have annual work comp, does not extend that tort immunity and does not stop them from suing under tort. We exclude pollution. This is broad form. It's absolute in the coverage here. There's really no pollution covered under the general liability policy, not even for the things that we talk about auto where there's a small area, and there's no standard pollution buyback endorsement you can add to the general liability policy that's even reasonable to be put on here. And so there's really no exposure here for us. The only coverage that you have is from the fluids for mobile equipment. And so in the case here, if the insured has a forklift, a front end loader, a crane that turns over, once it's off of the being used to unload. If it falls off the back of a truck, that's your insured's cargo, and CA 9948 would address that for the pollution happen. But once it's being used, turns over, then that would be covered under general liability policies, those areas. However, you got to think about offering pollution coverage if they have a location. Do they have a garage? Do they have a wash bay? Do they have a fueling facility? Early on when I was doing garage, which this is a garage operation here, a friend of mine told the story about walking up to a garage insured and says, "What do you do with the old oil?" The insured says, "We put it in this storage tank in the back." And then the agent asks, "Well, when it gets full, what do you do with it? Because we got to worry about exposure." the insurance said in 22 years it's never been full. So there obviously is a leak there. This is what we got to talk about. When you look at Google Earth, if they have anything there other than the payroll office that could create a pollution, then you want to look at site pollution coverage, which is available in the marketplace. Pretty reasonable for someone with a location to start with, as long as there's not a lot of things there. So this is what you want to think about for the pollution. Again, it's not going to be covered here. You have to have a standalone policy for GL. Unlike auto, there's not a really standard endorsement you can add. We also exclude damage to property. This is a care cost control exclusion. Your insured can have other property in their possession. Mainly, it would be the insured's customers, which would be covered by cargo warehousing. So just the coverage that you would need to cover that gap. If they have a warehouse, you want a warehouse policy. If you have a cargo, if they're hauling other people's cargo, you want a cargo form. If they're working on operators' vehicles, you need garage keepers added to auto liability. If they borrow someone else's truck or someone else's trailer, you want hired auto physical damage or non-owned trailer physical damage to cover their responsibility for those items in their possession. That's an endorsement on also the auto physical damage forms. And if you have intermodal, you'll have the trailer interchange. So you'd have to worry about the insured having property in their care cost control. The one main one here would be the warehousing and cargo exposure. The other one would be auto that you would have to worry about on the GL. The last thing, and probably the most important thing that we deal with here, is where you have auto and GL kind of working together. What you'll find is that where auto excludes GL coverage and while GL excludes auto. So it's best to have it with the same insurance company carrier all the time. If not, if they don't have GL, then there could be some problems, uncovered areas like we just talked about, and or you might be involved in some exposures or some coverages from underwriter. And if you're the only liability policy out, auto liability, you might at least have defense. Typically, again, smaller motor carriers do not buy until someone makes them. That's their customer. If you're a retail agent, you always want to offer it. Underwriters, if no GL and all you provide is auto liability, you could have claims involved that should be GL, but you're the only standing item there, so you'll at least have defense. This is what we have the important part to understand, that they do need the GL and the why. The definition of auto is exactly the same in both. Auto liability means a land motor vehicle's trailer, semi-trailer designed for travel on public highway, including all attached equipment, machinery equipment, or any land motor vehicle is subject to compulsory or financial responsibility laws or any other state vehicle laws in the state where it is licensed or principally garage. However, autos do not include mobile equipment. So if it's an auto, the auto policy responds by, if the definition of the unit is auto, it's auto responds. If the definition of mobile equipment, if it's a mobile equipment, it's the definition of mobile equipment, then a GL policy would respond. So the key part here, is it motorized and does it have to be licensed or not? If it's motorized and doesn't have to be licensed, then in most cases it will be mobile equipment. But if it's motorized and has to be licensed, then it might or might not be mobile. If it's motorized, then it might or might not be mobile equipment, depending on if it's licensed or not. So I looked at just the whole definition of mobile equipment, and I just took the 4 areas that I think could be a gray area. And in 3 of these 4, it's where you have a multi-business. It's not just true trucking. The first one I have here is 12A, farm machinery. I had a program in Florida a number of years ago where we cover harvesters. These harvesters had a lot of trucks, but they also had something called a goat. A goat runs around the field, in this case the orange field, picking up the oranges, putting them in the back of this goat, which is typically a smaller 350 type Ford dual rear axles with a flatbed on it, that they go out and put the bins that the pickers put the oranges in on the back of this, and they go dump it into the trailer sitting on the location to be hauled to the processing plant. When those goats are running around, that's fine. That could be GL on the premises, but think about it going from orange field to orange field, and then it would be licensed for the road. So that's where that farm machinery would be an auto because it has to be insured because it's on the highway, because the license plate requires it and proof of coverage requires to buy the license plate. Could be the same thing with the combines in the Midwest where you have you have hay and those things, the soybeans combine. It could be for the picking of tomatoes and those kind of things. So it's a multi-location here, operation here. So farm machinery would be a gray area. B is something that if your insurers have a terminal, they will typically have tractors that are dedicated to that terminal to spot trailers, yard dogs, yard tractors here. That would under be B. And the problem you have here is as long as they stay on the premises, you have no problem. But if they get off the premises now on the public highway, other than the premises directly adjacent to the location, then you have to worry about that unit being fuel in town. Does it have to be licensed or not? So it might or might not be covered under the GL or auto, depending on that interpretation. There's a couple situations that I found recently too that becomes a problem, and that's that your insured has a contract with a customer to spot trailers on the customer's premises. And so they send this tractor on the customer's premises to spot trailers. And now that vehicle is maintained solely on that premises, but it's not a premise that your insured owns or rents. It's the customer's. So even though the vehicle does not have to be licensed, it's still an auto and does not fit the definition of mobile equipment. The last two, again, are multi-function thing, and that is vehicles maintained solely self-propelled or not, maintained primarily to provide mobility, permanently mounted power cranes and drill rigs. Power cranes are your heavy haulers. Power cranes are the items that lift things off of the flatbed, off of the low boy trailers to install. It could be trusses, it could be generators on those things. When that crane is moving from work location to work location, it will then be on the road and would have to be licensed for the road. So therefore, it is an auto, not mobile equipment. When you have a drill rig, water rig, or a oil rig, a workover rig, a drill rig, those a lot of times can allow the derrick to be brought down and moved from drill location to drill location. Again, when that happens, it is auto because it's on the road and has to be licensed. And so again, they're not truly truckers. They have do heavy hauling, or they do well drilling, but they have trucks. And in those cases, those equipment they're using are not mobile equipment. They're auto because of the having to be licensed for the road. And the problem you have here for this is where the coverage applies. If you have any auto with GL with the same carrier, there's no problem with coverage. It's only when you have a specified auto only, then you have to worry about how your insurance carrier is going to interpret that farm machinery, those yard tractors, those power cranes, and those drill rigs. And you want to make sure that your underwriter understands those things from a coverage standpoint. You'd want them to understand even on the other from a premium standpoint, but the most important part is coverage standpoint. Why this becomes important is because on the bottom of the definition of mobile equipment, you have that statement that we found earlier in the definition of auto. However, mobile equipment does not include any land vehicle that is subject to compulsory or financial responsibility laws or other motor vehicle insurance laws in the state where it's licensed or principally garaged. Land vehicles subject to compulsory or financial responsibility laws or other motor vehicle laws are considered auto. And so you can even have a hybrid. Say you have in the Midwest, I've heard these combines, these things running from field to field. One state could say they have to have insurance, have to be licensed. One state that said they might not have to. So again, it could even change by state. So if your insured has the combination, again, you need to make sure how the insurance carrier is going to interpret those drill rigs, the farm equipment, the cranes, and you have to worry about the tractors that are spotted tractors on premises. Why is this important? Is because then we look at the exclusion G in the general liability policy. Exclusion G in general liability policy excludes items we're going to talk about, and everything excluded here is covered under the auto liability, under auto liability exclusions 7, 8, 9, and 10, which is handling mobile equipment, loading, unloading, complete operations in the in the auto liability policies. And sometimes this is misread here, so let's look at the exact words. We exclude, this is exclusion of GL, bodily injury property and arising out of the ownership, maintenance, or use, or attachments to or entrustment to others of any automobile. And that's why I notice this quotation marks. That goes back to what we talked about in the previous slides, and that is auto. If it's auto, meaning license for the road, mobile equipment, needs to be insured, then it's not covered in GL. It's addressed by the auto policies as long as it has the covered auto and has the right symbols. However, if it's not auto, meaning it's mobile equipment, then the general liability policy would respond for that. But that's where everybody stops. But it's not all auto. It's autos only owned by, operated by, rented, or loaned to any insured. So we're going to talk about that in more depth. This is your owner operator. This is vicarious liability. This is your garage operations. This is what is not excluded, even though it's an auto exposure. And so we don't exclude all autos. We only exclude autos that an insured owns, operates by, rented, or loaned to the insured. This exclusion also excludes loading and unloading. Again, that's the defined term. And that goes back to what we talked about, this what's excluded under the auto policy does not exclude what's excluded in a GL under loading and unloading. So drilling down to this, all auto forms and the GL forms are designed to work together to address the insurer's exposure in their business for all liability claims. The coverage under each must be understood to properly write either. General liability, exclusion G, is the general liability exclusion when general liability addresses possible overlaps with auto coverages, meaning a definite auto. It is, but it only excludes autos owned by, operated, or rented or loaned to the insured. So again, the definition of auto becomes important, auto and mobile equipment, and it's also how the insured is using it. If they own it, obviously it's there. Operated by, meaning that the owner operators, they're leased to them, same thing with lease, or they borrow those things, or loaned to the insured. Those are units here that you'd be covered in an auto by having the proper symbols used, either specified, any, or hired. But let's talk about you at repair shop. Repair shop on non-owned autos. No one needs a garage policy for liability coverage for premises operation, complete operation protection if they have a GL policy and an auto policy covering all auto exposures here. They might not agree garage keeper. But let's talk about this owner operator. This is an important consideration here. Does your insured use owner operators? If the answer is yes, put a check mark. Does your insured have a garage? The answer is yes, put a check mark. Does the insured work on owner operator's vehicle? Maybe not engine repair, maybe not transmission, but smaller thing. Will they repair a tire? Will they do something mechanical? Will they do service on those units for owner operators and charge back to owner operators? If you have it, then check yes. And so here's the gray area. So your insured repairs tires for owner operator. Your insured goes in. A lot of times they'll even sell the tires to the owner operator because they can buy them in a bulk. And now this is a convenient thing for an owner operator. And so your insured who has that owner operator leased to them puts that tire on the auto of owner operator's auto. And now the owner operator still leased to the motor carrier hauls a load, and that tire that they put on fails. And when it fails, it causes bodily injury, property damage. The people who sue will sue your insureds on that, and then and name your insured in it because they're leased to your insured at this point in time. Now we look at what has to respond. It's not going to be respond on the general liability because it is operated by or rented to the motor carrier. It's covered on auto because the auto insurance agreement says we cover the ownership, ownership, use, and maintenance of a covered auto. So as long as it's covered auto, then the auto liability would address that exposure for that failed work, the tire. However, let's say the same thing happened, but now the owner operator gets mad at the insured and cancels the lease and then drives off the premises, no longer leased to your insured, and has this crash. Now they're no longer operated by or rented to the insured who did the work, but so now they are not excluded. And so now the GL policy will respond to that crash for that failed work. This is also has a relevant part here about does your insured do work on non-operators, but not also do insured do work on their own vehicles. Because if they don't do work on their own vehicles, meaning the third party does it, they could have, when the work fails, even though auto has to respond, we could bring a third party in. Had a rich situation where we were insuring these harvesters, and they were this 18-wheeler hauling oranges from the field, ended up getting, unfortunately, crossed the line and ran into some Boy Scouts vans. Again, tragic accident. I hate when I think about bringing it up, it even gives me cold chills, but there was a lot of injuries there, more than $1 million our policy could address. But in the investigation, the driver was talking about, well, the steering was kind of loose here. I tried to pull it back, but it didn't respond quickly enough. So they investigated it, and they found that that unit had been worked on in the Peterbilt dealership in the city on the west coast of Florida. And so they looked at the repair bill. They saw that they did work on that. They were able to prove that at least the Peterbilt dealership did not do properly. So the Peterbilt dealership was brought in the case and paid a couple $1 million on that case. This is where you have the difference here, and this is where your garage situation. Now, if the insured is working on operators' vehicles or even allowing them parked, they will need a garage keeper's liability policy to be added to the auto policy here. The other thing we talked about earlier, brokerage. If I give you a load, I'm a broker, I arrange you a load. You haul that load. You have a crash. I get named in the suit because I allowed you to haul that load, whether I'm a broker or a shipper. How that case would work is that now, because I am held liable for your actions, meaning I'm vicariously liable, I'm going to qualify as a broker under your policy for have primary coverage and defense. But if you cannot settle it under your primary coverages, under the vehicle hauling the load, then it's still open for discussion. And then I, as a broker, look for my own coverage. And so now I look at my general liability policy and look at that in depth. Was when I gave you the load and you were hauling it, is that unit owned by me? No, it's owned by you. Or I'm operating? No, you're operating under your own DOT number and your own MC number, so I'm not operating. I did not rent it and was not loaned to me. So my general liability policy would not exclude that crash caused by that auto I provided the load to. Now, again, it's not primary coverage, it's excess on the coverage on the vehicle itself that caused it, where I qualify as insured, but that's the excess. A friend of mine calls this, lawyer friend of mine calls this a one and done. A lot of GL carriers don't know this happens. And so any of this contingency GL that brokers can buy, contingent brokers liability basically is a GL policy. From an insured standpoint, this is where you have the major exposure if your insured has transportation and brokerage in the same legal entity. This is an exposure that sometimes you don't think about in the GL underwriting part of it that you need to. There's also additional wording from the GL exposure. This exclusion applies even if the claim against an insured alleges negligence or other wrongdoing in the supervision, hiring, employment, training, or monitoring of others by the insured. If the occurrence which caused the bodily injury, property damage involved the ownership, maintenance, and use or others of aircraft, auto, again defined, or watercraft that are owned by, operated, rented to loan insured. This was put in because early on lawyers tried to double dip. They said that the motor carrier driver had a crash, that's auto liability, but the driver was put behind the wheel, was not qualified to drive, so that's a separate tort action. They didn't screen him right, they didn't verify the TDLs, and so they said, no, it's a crash. I don't care if the driver was negligent, wrong screening, and that kind of stuff, it's still auto. GL is not going to respond. However, again, there's a certain requirements for the previous employer to act to the inquiry from a potential new employer of a past employee. And if that information is not properly communicated based on the federal regulations, now that crash happens, now can that new employee of that ex-employee, new employer of that ex-employee say, well, I would not have hired Jane and Joe because if I'd known about what you were supposed to tell me about it, as a motor carrier, then you're brought into the suit. So this is exposure that you would have here if we're not communicating the required information about previous employment that's required under the CDL regs and rules. So the higher responsibility to the public, not covered if auto is owned by, loaned, or rented to an insured. So by screening the driver improperly, and the plaintiff attorney tries to talk about and bring insured because it didn't screen him properly, then there's no coverage here. But if the required information is not furnished about a previous employee to a new employer of that employee, and the information not furnished contributes to an auto accident, meaning we didn't tell about previous drug problems or previous crashes, but caused by, and that auto that caused it is no longer owned by the insured, operated, leased, or rented to the insured, then coverage exclusions not apply, so therefore there's coverage. So the required information that's provided must be done by our insured to meet the requirements of the CDL licenses, or they could have an exposure under GL. Exclusion G, and this is the big one here. This is the loading, unloading, the overlapping activities. When a truck is being loaded and unloaded, what form addresses damage to the public, not the damage to the item. That's item care custom control. That is the cargo coverage that would buy that back here. But we're talking about damage if that item being loaded and unloaded causes injuries to the public. Basically, any damage done when items are being loaded and unloaded, meaning damage to the public, before the move starts, sitting on the premises, sitting there, if it falls over, that becomes GL. When move starts, first touch to start the move by the motor carrier, by our insured, it's IL. From the first talk to it, to taking it from where it's set stationary to load it onto a vehicle to be as long as it's being loaded on the vehicle by a hand truck or a forklift or equipment not attached to it. Then it's transported to the new location, and it then gets unloaded to its final destination point. That's all auto. After it gets to the final destination point on the auto, and now it's GL because now it's completed operation. As long as it's moved by a mechanical device not attached, then also it's GL. So when we're unloading something here and it's sitting on the dock, it falls over as GL. When we first talk to it, getting it, take possession of it, our insurance, taking it to their vehicle for that, by that forklift they're operating, or by a hand truck they're operating, or carrying it, or by hand, which would be rare to do that, but unrunning an automobile is driving it by hand, then it's auto. If it falls off, it's auto. If it gets to the next location and then unloads it, it's not when it's at the curbside, it's when the insured's responsibility to take it to its final destination, that's inside the building, then it's still auto until it gets to the place that it's finally supposed to be delivered, and that's GL. Again, for more detail, you can look at the session that we did on loading and unloading, but this is just summarizing it here again in the GL to talk about how auto and GL works. So the underwriting you have to do to make sure you write it. Google Earth. That'll show you where they are, meaning metropolitan areas, rural areas, what's around it, which cause it. What are they? Meaning, as just a payroll office, do they do warehousing? Do they have a garage doing maintenance here? And again, these other activities that could create some pollution liability, or they have owner-operators on the premises, those kind of things. You want to look at the contractual exposures and decide how broad are those indemnification agreements. You want to make sure there's a waiver of subrogation in favor of the insured on OCAC and work comp policies, and you want to look at the state laws for the anti-indemnification. If they have any kind of pollution exposure, other than on the auto, which you have the CA 9948 endorsement, who buys that back, you want a standalone pollution policy to cover the premise locations exposure. Operation other than autos owned or operated by or rented to an insured. Again, if they have a brokerage in the same legal entity, that's a concern. During delivery, what are they delivering? Can it hurt something if they deliver? Put the wrong fluid in the wrong receptacle, I even had where they got contaminated, the food got contaminated, transportation. Now it is being eaten later. That's now GL after it's been delivered. Those are kind of things here. And again, how it's delivered. Is it forklift? Is it by hand? Is it a hand truck? You need to talk about that. And then garage operation. You need to have garage keepers to cover autos and the insurance care control. If not owned, the autos are not owned by the insured, added to the general liability policy. But they do not need a separate garage liability policy as long as the autos are covered. So do you know about other entities owned by the insured? Transportation only, is it they have other investment, brokerage, repair facility, other locations owned or contracted for leasing. Again, you want to have the classification limitation part of it here to add to it. So you're just dealing with the exposures that you know about, locations you know about. All insurers need a general liability policy. You need to make customers requirement. You need to meet customers requirement to protect their assets. You want a part of the package or a standalone. That's your choice. Auto liability with physical damage, GL, and cargo is the best. You'd have to worry about admitted and non-admitted. A lot of auto has to be written admitted. A lot of GL is written non-admitted. And so in those cases, might be the same insurance carrier, but you could have it different as far as insurance groups. You can have a different insurance carriers depending on admitted and non-admitted. But you want to combine them whenever possible. So the question when a crash happens is not is it covered or not, but which loss line is going to be charged to. And so that gets back to specified autos or not, and that gets back to mobile equipment or not, and gets back to these operations for loading, unloading, which are gray. So wrap up. Do you as an agent, retailer, wholesaler always offer? Why they need it? And then why aren't you offering it? That's your concern, to cover your exposure. So we hope you got more in depth about the GL, and the insurers need GL. Again, they don't do it by unless they have some reason, and I'm hoping you as a provider will be able to talk about the reasons and see where the exposures are. If you have any questions about this or anything else pertaining to these series, please again email us at trs@mcief.org. Thank you for your time.